Rohr here with an early, very concise highlight on Wednesday, June 24th, 2015. It's currently 8 a.m. U.S. Central Time, and we're coming to you a bit later than usual because we wanted to give the impact of the U.S. GDP release this morning some time to work its way through the market, and also wanted to wait to see if there were any further developments in the still fraught Greek debt negotiations. But there were some other macro factors that were important as well. So, what does all this mean to the markets? And just to begin, as usual, we've got the S&P future, 60-minute chart on the left, 30-minute chart on the right. And what we know is that after being burdened with the Greek situation going back into last week, from the beginning of the week, as things improved throughout the week, and it looked like you might actually end up with a potential compromise going back to Thursday. Well, that ended up putting the S&P back above the key 2100 to 2096 range. But then on Friday, as things really looked like they were not going to succeed, you went right back down to the 2100 to 2096 range after getting up near the important failed up break in the 2119 area on Thursday. Well, as we come in on Monday and Greece puts in new proposals, we gap higher in a massive way from a $17 sell-off Friday into this gap higher by about $17 on Monday. But then where we end up is no better than 21 or so. In fact, the congestion above that down break runs up to about 23 to 24. So this is just retesting failure areas from the failed up break during May, where the market took so much pressure again into the first part of June. Now, we're sitting right now due to, again, this latest rejection of the Greek proposals down at 2111. So we're around yesterday's lows. But the rejection came with a suggestion as to the changes in the program Greece would have to implement, which are going to be tough for Alex Tsipras, Prime Minister of Greece, to get through the Greek Parliament. So the markets are a bit defensive right now because they are running out of time to come up with the money to pay back the IMF loan that looms so large. And with that, technically what we know, after discussing all that fundamental background, is on Friday, out of its aggressive up channel from the last low back down near the 2060 area, going back to a week ago Monday, this market left a down break at 2106. That happens to be a key Fibonacci area on the recent swings as well. So even though the more major support will remain 2100 to 2096, if it sags off to 2106, we're going to have to keep a close eye on that as well. And the higher resistances remain as discussed. 2119 is the bright line level, but with congestion all the way up into the 2123 to 2124 area. And what's interesting on the indicators is that this sideways drift has left the hourly MACD remaining below this upper runaway band. This is another reason you really have to escape the low to mid 2120s in order to probably put the market back on a more sustained bullish footing. And that pretty much does it for the short-term view of the S&P 500.